So the recent action in global equity markets certainly got investors' attention, with a relatively steep and fast drawdown followed by a climb back to new highs for the MSCI World Index, driven by the stellar performance of U.S. equities. While we did have a snapback, are there any lessons to be learned for investors? Let's break it down. The drivers of the downside volatility are not exactly clear. The consensus right now is that we are at or near the peak in growth for the economy and in earnings growth. That's no surprise. There's growing consensus that a potential infrastructure package from Washington may be smaller and it may take longer than planned. Again, this should come as no surprise. So what were the culprits? I would point to three: that the bond market is beginning to signal a tighter Fed, that the rise in COVID cases may influence the shape and trajectory of the economic recovery, and that the regulatory crackdown happening right now in China on tech and other sectors may intensify. These are three surprises, so let's tackle them one by one. First, we think that the recent decline in interest rates is right, but for a different reason. Rather than an aggressive Fed, we think the post-COVID pace of economic growth and inflation will ultimately be low, and that this will present a problem for the Fed and may delay policy liftoff. Second, the increase in COVID cases driven by the Delta variant is notable. However, we believe that the focus will increasingly be on serious illness and hospitalizations, and that's where we see a much more gradual trajectory. We do not anticipate significant mitigation measures to be imposed that would undermine the recovery. However, the speed of the recovery may indeed slow as a result of the Delta variant. And last, the crackdown in China is a concern, and in our view represents another valid reason why companies in China should have a lower valuation than those in the U.S. Investors need to be compensated for this ongoing and unpredictable political risk. Ultimately, however, Chinese authorities must understand that the targeted companies and sectors represent significant future growth, and it behooves to encourage innovation. This bears watching. Importantly, what we saw recently is that the risk asset markets are quite vulnerable to any change in sentiment, and what makes them so, particularly with respect to U.S. risk assets, is the current high valuation. While we've noted many times that valuation is a poor market timing tool, high valuations do leave markets vulnerable to a real or perceived change in the outlook. For investors, we reiterate that volatility is a feature and not a bug in equity markets. We remain constructive on risk assets, and it will be important to stay the course during these periods of volatility because it's likely we will face more going forward.